Good Thursday afternoon, everybody. This is Finom Group, our weekly state of the market. I am your host, Seth Golden. And unfortunately, as usual, I know I'm laughing, but when we do the state of the market, we seem to be followed by pretty red days in the major averages. And today, unfortunately, as I mentioned, is pretty much what you see on the board, red across the board. We got a little bit of a pullback going on. Maybe this will satisfy, some of the market participants that have continuously called for a bigger market correction and/or pullback. So with that being said, let's dive right into this weekly state of the market and see what might be in store for us, as well as taking a look back at some of our recent activity. Title here, as you can see, how to play a potential market pullback. Now, I'm not saying we're going to get a big pullback. The biggest pullback we've had so far this year is 4.2% on a closing basis. We've yet to have a full 5% pullback, and maybe it's on the horizon. As we always do with our weekly states of the market, I like to kick things off with a quote. This one just happens to come from me. This is something that I kind of live by when it comes to investing and trading. The difference between underperforming and outperforming often comes down to two simple variables: concentration and conviction. What does that mean? Well, you probably heard of diversification versus concentration in your portfolio. A lot of people favor diversification as a safeguard against catastrophe in your portfolio, from one individual name or a couple of individual stocks, so to speak. But the reality is diversification, doesn't tend to give you the highest rate of return. So a lot of folks, rely on stock picking, and it takes a goodly amount of conviction when you're going into stock specifically, a specific or a specific sector, specific stock or a specific sector. The higher the concentration, if it's a winner, the bigger the return. And it takes a lot of conviction to go that route. But again, the higher the return, the greater the probability you're going to outperform. I'm not saying lean away from diversification. If you're a good stock picker, you got a good track record, you might want to think about leveraging that skill set even higher. If you're not, your limitations, stay diversified. No harm, no foul. All right, another quote we have here from Benjamin Graham: the investor's chief problem, even his worst enemy, is likely to be himself. And this can manifest itself in a variety of different ways. But oftentimes we look to lay blame as to why we may be underperforming or not achieving our investing and trading goals, when in reality, it's often our own fault. And we are our own worst enemy. It's easier to blame others. It's easier to blame outside variables that are beyond our control. But again, oftentimes that's restrictive to our success by blaming others. The more often that we recognize our own shortcomings when it comes to investing and trading, the more likely we are to course correct and improve. A lot of our members, you probably recall a lot of this content here, this chart of Pepsi, 5-year chart. We had been talking about this in our recent research report 2 weeks ago. Pepsi reported results. This is one of our ideas, if you will. It turned out to be a great trade as Pepsi reported earnings this week, and the stock shot up to new all-time highs. Hit 155 plus recently from about 148, 149 2 weeks ago when we delivered this content and this idea for our Finom Group members. And I always appreciate it when I get feedback from our members. And here was some feedback from within our Finom Group PM chat. We have a Telegram app that our premium and mastermind option members are able to engage with other members from Finom Group, as well as myself and Edward. And here was, one of the comments that one of our members had offered. Side note, meant to thank you for pep ride. We have been on the last year plus. A lot of our members know last year we started developing a core holding in Pepsi through swing and scalp trades. We literally traded Pepsi 38 times last year, buying the dip, selling the rip, buying the dip back, selling the rip, time and time again. And every time we would do so, we'd tuck a few shares, to the side to hang on to, and we would build for each trade until we got to a level that we wanted to hold on to long term. And if you go back and you look at the share price where it was last year and you look at the share price today, it's been a substantial winner. Was a category I never owned, and I am very guilty of poor tracking, but with our dividends and scalps and core trimming and recapturing, it has been a monster for me in the most boring way, while remaining a swan sleep well at night. I am not opposed to get rich slow, and this stock screams of that. Still in it with 1% core and hoping for a pullback to increase after today's trim. So that was just a couple days ago from one of our Finom Group members. And indeed, there's nothing sexy about Pepsi. It's a slow, steady eddy. It went through a goodly amount of consolidation here from last year into this year and finally broke out to 155. I mean, look at all the buy the dips and sell the rips you could have done here along the way. Again, this is a 5-year chart, so it doesn't really point out how deep some of these actually are. But, slow and steady. There's nothing sexy about Pepsi. You get paid almost $1, a little over $1 per share to hold it, just to hold it in dividends. Get it done. Get it done. All right. So coming into this week, looking at this table from Bespoke Investment Group, the S&P 500 made a new 52-week high again yesterday. But within that making of a new high, more group ETFs, the different areas of industry, if you will, were actually oversold than overbought. Here's the oversold. Here's the overbought. We have almost, you got to go all the way down here to get anything in the overbought territories. 1, 2, 3, 4, 5, 6. You got a bunch in neutral territory. And you got to have, a couple handfuls here in the oversold territory. Again, this speaks to market breadth. We're making 52-week highs. We've got a lot of oversold and neutral, characteristics among the industry group ETFs. It does not speak well of market breadth. As of today, we have 41 new highs. 41 new highs already here in the S&P 500 for 2021. When I was constructing our weekly SOTM, we had 39. Through this week, we've tacked on another 2 all-time highs this year. If the year ended today, obviously it doesn't, 2021 would be tied for the 12th most record closing highs in a given year. At the current pace, though, the S&P 500 is on pace to have 74 record highs on a closing basis this year. And that would rank as the second most of all time, behind only 1995. There's that date again. The only other years even close to 1995 total were 1964 and 2017. For those of you who remember, 2017 felt like this year, here in 2021, where we've had very shallow pullbacks. In 2017, the biggest pullback we had was just under 3% on a closing basis. And again, it speaks to while the average year will have 5% pullbacks, there are some years where you won't even get that. 2017 was one of those years. This chart right here, while the market rose nicely on Monday, it also came with less than optimal performance underneath the hood of the index. Only 30% of S&P 500 members beat the index on Monday. Now, less than half of S&P 500 stocks are beating the index year to date. That's this bottom panel here, comes in at 49.5%. This is Monday in green. Only a third of stocks, 33%, were outperforming the index, marked by the arrows. Greater than 66% outperforming the S&P. We looked at this chart last week. So just focus in on the S&P 500 top box here. This was the look. This is the look now. This was the look last week. This is the look now. And you can see underneath the surface, the good stuff ain't really happening here. Equal weight versus the S&P 500, which tells us a little bit about breadth of the market also, continues to go this way while the index is going this way. The index is cap weighted, but when we look at it from an equal weight versus the index cap weight, it's going down. High yield bonds, a measure of risk on, if you will, has also been consolidating and moving lower recently. High beta, again, another variable of risk on versus risk off, going down, signaling less risk appetite. And of course, the Russell 2000 versus the S&P 500 going the opposite way. So breadth underneath the surface while the index is doing this. And we've known this for several weeks now, maybe even a month or so, that breadth has continued to weaken. And it looks ominous when you look at equal weight S&P versus the S&P cap weight on a relative basis. This looks very scary. But on an absolute basis, the equal weight S&P 500, it's just consolidating. We could square this off, and we really haven't done anything but consolidate through time. While the index, the cap weighted index does, or the SPDR ETF, just continues to march higher. Now, eventually, this could pose a problem. And maybe today is the onset of that problem with the indexes, pulling back here. Remains to be seen. We have to give it more time. Let's see here. The last 2 months that have it is just the last 2 months that have caused the equal weight S&P 500 to give up nearly all of its 2021 outperformance versus the SPDR, the cap-weighted S&P 500 ETF. The equal weight was up 18.2%. The cap weight was up 16.6% coming into today's trading session. There was a much bigger gap between these two until, basically that has been narrowed. As you can see here, it was a lot bigger, but over the last couple months, it's narrowed greatly. There have only been 2 other periods where we've seen the 2-month performance spread turn more negative for the equal weight S&P versus the cap weighted S&P. The first was in October of 2008. Nobody wants to see that. The second one was in late March of 2020. And of course, nobody wants to see that. When you think about those 2 dates, though, these are 2 examples that show we normally see the equal weight S&P 500 significantly underperform the cap-weighted SPDR when the broad market is falling, not when it's rallying to record highs on a daily basis. So you could also view this type of market breadth or relative performance as just another healthy rotation. Remember, equal weight was outperforming the cap weight S&P 500 all year long until the last couple of months. Well, at some point, equal weight's going to consolidate, right? And the cap weight, which is going to be led by your fan mag names, they're going to come back to life. And that is exactly what has happened over the last 2 months. Rotation, rotation, rotation. It's not as scary when you put the puzzle pieces together as some of this risk off, relative performance is indicating. If you can follow the sequencing of what's taking place, who's leading, who's lagging, who's consolidating, and who's starting to break out, it's not as scary. It's almost to be expected, right? And we've seen fan mag names just take off over the last 2 months. Google new all-time highs, Amazon all-time highs, Microsoft, Apple, finally breaking out and making new all-time highs this week. Speaking of fan mags and the S&P 500, right now the market has been led by the big five: Facebook, Apple, Google, Amazon, and Microsoft. And they're flirting with new highs when it comes to their percentage of the overall S&P 500. And that's what you see here in this chart. It's only been a higher concentration back in July 2020, it looks like. And these names have helped to mask some of the weakness in other areas of the market. Or you can look at it as they're catching up to the other areas of the market as the market has rotated once again. And why are the fan mag names, coming back to life? Well, where are you going to get the growth from? Like, where is that safety? Where's that reliability of earnings and revenue growth? Right? It's in a very select few names, and that's what this chart basically shows you here. The number of S&P 500 stocks with top line growth greater than 15% on a 5-year rolling basis. Back in 1999, 2000, over 200 names had those characteristics. Nowadays, it's like 60, 65 names that are growing top line at a better than 15% clip. Scarcity drives a premium. You think that's only the case in Bitcoin? One reason is that there's not many of these names. During the dot-com period, as I said, there was a lot. Nowadays, there's not. Scarcity creates premium. So in speaking of breadth, one of the things that we know is coming into today's trading session, we once again had less than 50% of S&P 500 stocks trading above their 50-day moving average. Seems like that's an ebb and flow, never-ending story lately. Same thing with the NASDAQ. The NASDAQ has been even worse. Came into today with 34% of stocks trading above their 50-day moving average. But keep in mind what we saw on April 14th. Better than 90% of stocks were trading above their 50-day moving average. When that happens, good things tend to happen going forward for the S&P 500. 3 months later, the average return is 4.6%. Positivity rate, 91%. It's almost never red. And guess what? As of July 14th, which would have been 3 months after the signal, the market was up 5.62%. Put another green box here. 6 months later, the returns get even better, 83% positivity rate, and 1 year later, there you go. So breath is pouring out. So much of the market was doing well, through the first half of the year or first 5 months of the year. And then that large part of the market decided to consolidate. The tech, the growth, the NASDAQ came out of its consolidation phase and broke out. NASDAQ reaching think it has 19 new highs year to date now, another new high this week, but it's a smaller part of the market. While the rest is consolidating, only that narrow part of the market was advancing with FanMag. But good things tend to happen after this signal. We'll see, if we get to color this one green as well, 6 months out. August, September, October. We'll find out come October. That'll be the 6-month mark there. Again, we have not had a 5% drawdown in the S&P 500, and as of today, it's 181 trading days without a 5% correction. We've gone over this before as well. This chart in front of us shows that the mean, the mean period where you typically get a 5% correction within a secular bull market is 104 trading days. So we are well beyond that, obviously. Well beyond the mean number of days in which we usually get a 5% correction. Do you want to be positioning for the inevitability? Or do you want to lean into this? Because you could have said that on, the 105th day, the 120th day, the 130, 40, 50, 60, 70, 80th day, and been wrong by going short the market or short equities, carrying a bearish bias. When you get this far in front of the mean, there are some unique circumstances that are creating this. I tend to think it's earnings, but we were also up 3 weeks in a row in the S&P 500. Should we be looking for a 5% correction now based on being up 3 weeks in a row? Well, it's basically the blue lines here represent when the S&P 500 has been up 3 weeks in a row going back to 2012. And the reality is not really. The red lines represent 5% pullbacks. And I've only got 3 on the screen here, folks. So just because we've been up 3 weeks in a row, that's not necessarily indicative of finding a 5% correction or consolidation either. Some data that we've also looked at, some quantitative data in the last few weeks here. We've had long monthly win streaks, right? We're up 5 weeks in a row in the S&P 500. 1 month later, market tends to be higher, 77% of the time. 3 months later, not as good on the positivity, but gains are even better. 6 months later, good stuff. 12 months later, momentum begets momentum. Objects in motion tend to stay in motion, right? We've talked about that before as well. But what about the drawdowns in between, right? Like, what about the drawdowns maybe between, the 6 month and 12 months, right? How big of a drawdown based on being up 5 months in a row might we expect to find? And that's what we see in this study here. Chris Shavako of Shavako Capital basically looked at each date in this table here, looked at each date to find out what the 6 month drawdown might be and the 1 year drawdown. So if we got a 9.9% one here in 1975. The biggest one is 2018, 18.97%. But the average of all these dates is 3.9% drawdown. When you've been higher, when the S&P 500 has delivered positive returns 5 months in a row, the average 6 month drawdown is only 3.9%. The average 1 year or 12 month drawdown is only slightly higher at 4.03%. Again, there are outlier years within here that have bigger drawdowns. But we got to look at the average at least. It gives you, a better, aggregation of the data. So again, nothing really is sparking that higher probability for a 5% correction. It's just not there yet for the S&P 500. This is not the NASDAQ. Do keep that in mind. This is not the Russell ETF either. Long quarterly win streaks can produce volatility. We've also been up for 5 quarters in a row. The next quarter is typically still positive, 63% of the time. 2 quarters later, market's still positive, on average 4%, 82% of the time. 4 quarters later, you see the data. We've also had new high streaks for the S&P 500, 7 consecutive days of new highs recently, 7 consecutive days of new highs. That's a little bit more rare. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 occasions, I think, here. Oh, 8. I miscounted. 8, sorry. Incredibly, this has happened only 8 other times since 1950. So going all the way back to 1950, that's a broad span of time. We got a sample size of 8. Again, 1 month later, 3 months later, 100%, 87% of the time positive 6 months later. Khrushchevako took the dates once again to find out the max drawdown 6 months, 6 months later, and all he could find, 1.77% on average, the drawdown. The biggest drawdown right here, 1965 at 6.83%. I mean, again, only a few times has this happened in the past. It just really speaks to how unique this period is, and what's driving investor flows, fund flows and appetite. Maybe the appetite's not been there lately as investors are looking for bargains, and bargains are hard to find. But when you see this kind of set of circumstances, it's very unique. You lean into the historical probabilities. Still, nothing is pointing to a 5% correction. Doesn't mean it can't happen, because it did happen once in 1965. But we're looking at the average to give us the probabilities. Everybody's been fretting over the yields. Even today, yields are once again under pressure. They were under pressure again yesterday. We're at the low yield of the day here. We had a nice bounce from 1.25% on the 10-year up to 1.42%. We've literally given back 12 basis points here in a matter of 2 trading sessions. So everybody's still worried. Is there a signal? What is the bond market trying to tell us? Is it trying to tell us about inflation? Is it trying to tell us that the economic growth won't be as robust as many think it will be? In my opinion, it's not a signal. I mean, when you have the central banks in there to the extent that they are, it's almost an impossibility that the bond market, that the yield curve can throw out any probabilistic signal. I mean, the Fed's in there. They're the biggest purchaser of treasury assets and securities. It's almost impossible for there to be some kind of plausible, effective signal thrown off by the bond market. In my opinion, it's more noise. It's more noise. It enables, the financial media to deliver content, speculation, analysis. Everybody's got an opinion. Fills up programming time throughout the day. But again, to me, that's all it really comes down to. We know the central bank. We know that's a market that is somewhat manipulated because of the largest purchaser of assets gives you their guarantee. We're still purchasing these assets. All right, moving on. And, they say that the bond market's the smart money. That's another reason people look to the bond market. In my opinion, not so much. Again, you have a guaranteed purchaser of assets. It's hard to find a signal in there. But this is the sentiment traders, smart and dumb money, confidence indicators. Smart money in the blue, dumb money, confidence in the yellow. Naturally, they say the smart money is the the large commercial hedgers and institutional traders. The dumb money is the smaller odd lot traders and speculators. But as you can see, the dumb money positioning has grown increasingly confident since mid-May. There's mid-May, and it's been traveling higher, increasingly confident. It's not yet back to the levels of earlier this year, but they have grown increasingly confident. But you can say the same thing with the smart money confidence. I mean, look at where that has traveled to, bridging the gap, if you will. What we got here is, while a move into extreme optimism territory, noted by above 70% level, would raise some alarm bells, it's worth noting that the smart money confidence has also been rising, and for a longer stretch of time. As the label suggests, that cohort, the smart money, has tended to be more right at extremes in the past. That being said, the dumb money has largely been correct in its positioning for much of the stock market's rally since last year. I mean, if we go back to last year, look at this, look at the dumb money down here. I mean, they have been buying, probably since the bottom, and really haven't lightened up terribly much on that gas pedal. And they've been right in doing so. Whereas, the so-called smart money was lightening up, and all the way into 2021. They've only been coming around since the new year. Smart money has not been so smart. I had mentioned noise before, signals versus noise. For a lot of our members, this is one of my pet peeves, this whole Michael Santelli mystery broker crap. And I've got no problems calling it crap because that's how I see it. This was from June 14th. He does this every month. Apparently, Michael Santelli has a friend that, when they worked together, they were colleagues at Barron's magazine back in the day. He still has a good relationship, and this guy apparently, gives him his outlook on the market. Guy or girl, I don't know. The mystery broker says he's not changing his view. This was back in June. Still sees very little further S&P upside and significant correction before long. Continues to believe outperformance of cyclical value over growth will resume and persist longer than most expect, if by a more moderate degree. Cyclical over value, further upside. This is like the call, but there's not really a call here. I break it down in my tweet from the other day. There is no real call here, just ambiguity litter. Very little compared to, sees very little further, compared to what? What does very little mean? Is it 1%? Is it 2%? Is it 3%? Is it 5%? What is very little? And what is before long? A correction before long? Is that 1 week? Is it 2 weeks? Is it a month? A quarter? What is it? It should be cyclical value over growth will resume. Well, when? Again, is it next week, next month, next quarter? When? I mean, all of this is just open-ended ambiguity here. It's a prime example of noise with no value for the average investor. Michael Santelli, he's on CNBC as a host. And just as a heads up, from this call, the S&P 500 to July 14th was up 3%. Would you have wanted to sit on the sidelines for that 3% rally because somebody believes a correction is coming before long and there's not much upside left? Don't worry. Like I said, month after month after month, here he is, July 14th, with pretty much the same ominous calls. Been doing it since last year as well. Same kind of be careful. We're bound to have a nasty correction. I recall December of last year, nasty correction. I recall we're starting to set up like we're going into 2018. And we remember what happened in February of 2018. We had Volmageddon. We had that one day One day, 5% pullback in one trading session for the S&P 500. And indeed, it was a nasty day. That was in December of 2020 that the mystery broker was making that kind of commentary. Well, be careful. We're setting up for, 2018, kind of a likeness of 2018. It's just noise. This doesn't help anybody. It's not actionable. And it's constant, unfortunately. What about the market crash call from famed mortgage market meltdown and housing bubble guy, Michael Burry, right? Michael Burry had recently called for a market crash, and then he deleted his Twitter account. Like literally a couple of days later, he deletes his Twitter account. He's been making various calls on various sectors since 2017. Most of them don't pan out. Tesla stock will collapse like the housing bubble. It's down 22%, 23% return to date. Do you not think that at some point Tesla is not going to find new all-time highs? Well, if you do, that defies history. And don't get me wrong, I'm not a fan of Tesla as a stock, because the business model is it's tough. Look, if you got to keep going back to the debt markets to sell debt in order to raise capital, something's wrong with your business model. Like, at what point do you generate free cash flow consistently, whereby you don't have to keep going to the debt markets? There's something called a Ponzi scheme, and unfortunately, Tesla has those similarities. So I get it, but Tesla stock just goes up and up over time. So he's going against the grain with this one, and we'll see what time holds in store. But 2017, expect a global financial meltdown and World War III. Market is up 93% since then. So, I mean, if you want to talk about speculation, he says Bitcoin is a speculative bubble. Well, A, no crap, but B, none of this is crashing. These calls are more speculative than anything else. Noise, noise, noise. You got to learn to block out the noise, because that's what you're going to get a lot of in the financial media, folks. At some point, we are going to get a 5% pullback, if not more. We don't know when that is. We don't care when that is. We shouldn't care. We should have a game plan on hand for any types of, protracted corrective activity. What we know right now is we got ample fiscal and monetary policy still working through the system. As of today, those child care tax credits have just gone out. Let's take a peek at the market here. It's gotten worse. And then looking at the market, it's very defensive. Coca-Cola, Pepsi, Walmart, Costco, those are your green areas of the market. Just about everything else, including financials, which were up and are outperforming today for a change, have come under pressure. It's a lot of defensiveness here today. This is just one day. Have that game plan. Know what you want to execute. All of our buy the dip signals are still in play. We still have the yield curve, which is 115 basis point spread between the 10-year and 2-year. We don't have an inverted yield curve. Buy the dip. Credit spreads are at their tightest level since the pandemic. Buy the dip. Monetary, fiscal, flowing through the system. Buy the dip. Earnings are growing and continue to beat consensus analyst estimates. Buy the dip. What are you buying? I'm looking to repurchase some shares of Pepsi in the near term. And where I am taking profits, as I have been over the last couple of weeks in the Golden Capital portfolio, I'm looking to reallocate into new ideas. Where I see growth, remember this chart, folks, there are very few companies to date, very few companies that are growing their top line at 15% or greater. I'm looking at these kind of companies. With that, I hope you enjoyed our weekly State of the Market. Subscribe to receive this every Thursday at phenomgroup.com. Have a great trading day, everybody.